My name is Jan Janssen, and I'm presenting today my contribution about management accounting perspectives for long-term sustainable decision-making in business, past, present, and future. What is our agenda? Well, we start with introduction, then we continue with the economic system, development of management accounting, traditional school of thought in accounting, hidden internal costs, hidden external costs, true pricing, and what will be next. Well, let's first start with the definition of management accounting. And I'm not going to read them all, but you see here highlighted a few keywords. And one of the most important one is decision making. So management accounting is helping managers to make the right decisions based on some economic calculations, financial calculations. We use past, present, and future. And the past is the traditional management accounting based on traditional accounting, let's say with the start from the Industrial Revolution to the early stages of the 20th century. Then the present, activity-based costing, total quality cost, life cycle accounting. Then we are talking about, let's say, the middle of the 20th century till about now. And the future, that is about true cost accounting, for instance, where we take care of the cost price in terms of negative environmental costs like pollution and the social costs like underpayment. And we try to monetize that, those two environmental and social costs aspects. To answer the way of calculating, we have to think first about in which economic system we live. And that is summarized over here. We live in a so-called VUCA multipolar world. VUCA means volatile, uncertainty, chaotic, and ambiguity. Multipolar means that we have not only one leading power block in the world, but several. And I summarize them from a economic point of view. There are a lot of other possibilities. There is a more classical, neoclassical market economy or Anglo-Saxon model. We find that in the United States, Canada, Australia, United Kingdom. The social market economy, mixed economy, Rhineland model, we find it in the European Union, countries like the Netherlands, Belgium, France, Germany, Scandinavian countries are quite similar economic structure. Then we have the command or plant economy, which is not existing really anymore, but often mixed with market elements. We find it back in China, in Vietnam, Russian Federation. And there's a third way where we combine aspects of the plant economy with market economy. We find it in Brazil, Indonesia, India, but also in a lot of African countries. Coming back from the economic system, we can now think a bit more about the production factors. In traditional, let's say, approach of economics, we will find it in, for instance, Samuelson. We see that there are four factors: nature, labor, capital, and entrepreneurship. And those four we see also back in, let's say, new developments. That's why I summarize them with the same color. We see that in, for instance, the 6 capitals from Gleason White and the IIRC. Natural capital, then 3 types of human capital, intellectual capital, human capital itself, social and relationship capital. And we see capital, financial capital, manufactured capital. And of course, in the triple P approach or the donut economic approach, we see planet, the planetary boundaries, the stewardship, the people, the social boundaries, the labor ethics, slavery, exploitation, child labor, And profit, the ethical boundaries, the right business model, the long-term orientation, stakeholders' value, financial goals, non-financial goals, and of course again stewardship. Well, this is an overview that plays an important role in the way we calculate our cost price. The development of management accounting. And that's in fact one of the core slides I will show you right away now. It's also explained in the article in more at a more deeper level. We see over here management accounting 0.0 on the left side, developing into management accounting 100, management accounting 2.0, management accounting 3.0, management accounting 4.0, and management accounting 5.0. And the developments are partly part of the, let's say, developments in a historical way, in the developments in technology, in ways of thinking about how a bookkeeping system works, from, let's say, single entry to double entry into triple entry bookkeeping. The developments in IT, from a simple bookkeeping system into ERP, into cloud computing, into distributed ledger systems, and new ways of data science for instance, the impact on forecasting. And we see that those aspects play a role in the development in a historical way of management accounting. Especially the number of management accounting 5.0 is important, where we see that the new idea about looking at factors of production play an important role. We would like to monetize social costs and environmental costs, and that's not always so easy. And for that we use a lot of, let's say, possibilities like shadow pricing, cost-benefit analysis, and similar techniques to monetize that in the cost price. And it also means that consumers are paying a higher price for products that are produced in a more environmentally friendly way, in a, let's say, social, ethic, correct way. Of course, you can read more about this in the article belonging to the presentation. To give a short summary, neoclassical economics, they looked at the 4 production factors, and that was very simple. There were a few cost components, and that was used in management accounting, absorption costing and full costing, like direct costs, indirect costs. That's the cost price, plus the profit is the selling price. In the, let's say, more paradigm shift of true cost accounting or integrated management accounting, we see still direct costs and indirect costs. But now we add environmental costs and social costs. So the cost price is now called the true cost price. Well, the profit is still the same, and then we have the true selling price. And this is happening, let's say, based on a lot of, let's say, developments in the way economists, management accountants think about how the world is running. And this is summarized in the last slide about this topic, where we see a lot of, let's say, developments, the limits to growth, starting with the Club of Rome in the early 1980s, ESG, SDG, PPP, FUCA, IT, data science, they play in a role, and especially, like we said, the impact on environmental costs and social costs are important for the development and calculation of the concept of the true cost price. Let's go back to a traditional way of thinking, absorption costing and full costing and activity-based costing. Well, the basic idea is of management accounting, it helps, let's say, managers to make a decision. So that's always linked to the future. But often you need data, and traditionally those data came from the past. And they came from the bookkeeping system. And why do managers, or why do companies have a bookkeeping system? Because they are forced to do that for the tax office reasons. All sorts of external accounting rules play a role, like US GAAP. And we use those data to calculate, for instance, future costs, future decisions for investments. And there's no external rule that is organizing this. It's the development of the thinking about management accounting in theory, books like, for instance, Warren, Grant and Drury, Atkins, Kaplan and Norton, as, let's say, important authors of those, let's say, management accounting books. So management accounting is using financial accounting and cost accounting. But also, since the late 1980s, non-financial data based on the balanced scorecard theory of Kaplan and Norton. And why we do this is to make the right decisions, but also to monitor them. And that's, let's say, the whole idea about management accounting. Finally, about the traditional cost accounting theories, we see that there's a focus on direct costs. They're often also called variable costs, but we can also have indirect costs that can be variable, but in most of the cases the direct costs are variable. And we have the fixed costs, and they are in most of the cases the indirect costs. Also, there are some examples of other indirect costs, but those two, as seen in box 1 and box 3, they are important for the concept of full costing or absorption costing. Let's go to the hidden costs. And the hidden internal costs, we see them in a company. And they are often indirect, so they are not direct traceable in the cost price. For instance, quality costs, the learning time of the staff when something new is introduced, new software, often delays when there is something new introduced, new process, for instance, if you have talking about process innovation. In some cases we have double systems. You take more than one time a record, so you have a shadow bookkeeping system. Too high inventories as a buffer, unused capacities also as a buffer. So those are hidden internal costs. It can be lower, but for some reasons, well, they're still too high. And it can be strategic reasons, by the way, to do so, but in most of the cases it's sometimes not well organized. Then we have the hidden external costs. They play an important role because nowadays we look in a different way to the social and environmental aspects in the cost price. Like we see over here, the hidden external costs, we see a definition of PULF. They are not in the price included, and we focus in the red box on the bottom right. The cost of pollution, deforestation, waste, excessive use of water, etc., etc. Those costs we like to monetize. Not so easy, but it plays an important role in the true cost prices. So that means, and that's already a step to the next section, the true cost price consists of three aspects. The traditional cost price, based on the market cost, direct cost, indirect costs, but also the social costs, the costs of, let's say, underpayment, poor labor conditions, child labor, and the environmental costs, based on monetizing the negative externalities caused by producers like pollution, deforestation, damage, etc. This brings us to true pricing. True pricing is a balance between the three aspects we just saw: the traditional cost accounting, social costs, and environmental costs. So it's about profit, people, planet, the triple P, that plays an important role. And in some, let's say, areas in the world, it's already balanced. But in a lot of areas in the world, it's not balanced. And then we have to take care of that the costs of the environment and the social costs, they should be allocated to the cost price, but that's probably a long way before that happens on a global level. But we see the trends in, for instance, the European Union, but also in parts of the Anglo-Saxon world. And let's also not forget that a lot of those developments we see also in China and India and Brazil. What will be next? Well, that's always difficult to ask to a person, but I think we are in the middle of some paradigm shifts in the way we think about the economy and management accounting. We live in a very hectic world, characterized by the word VUCA, and also characterized in a multipolar world where we have some, let's say, power blocks of countries that are relevant at this moment. And of course, there are a lot of new developments in finance, accounting, and control, like is listed from 1 till 7, and probably there are more, but those are the 7 most important ones, and I already mentioned them, so I will not do it again. So, what suggestion I have, maybe that it was based on my research in the coffee sector. We have a supply chain. We can see that on the left-hand side: farmers, syndicates, exporters, importer, wholesale, retail. And we have the cost price. And in the cost price are the direct cost, the indirect cost, the social cost, and environmental cost, and the profit margin. And if we show this in, let's say, integrated way to consumers, they are probably willingly to pay more than they were used to before social costs and environmental costs were not included. It's also a paradigm shift for companies. They don't really like to publish how well they are doing with their profit margin. But for consumers, that can be relevant information to see that the profit margin is okay, but if the profits are too high, you can ask some ethical questions. So implementing a true cost price system is not that easy. It depends very much on expected legislation. That can be national, but also supranational. It's about consumers. Are they willingly to pay? And how do you think about ethical behavior? It's about entrepreneurs. Are they using the Rhineland business model? Thinking about stewardship, ethical behavior. And to be honest, we see also very interesting initiatives like, for instance, the Fair Trade brand, where there's a check on how well some agricultural products like coffee and bananas are produced in a fair way using the ideas about true cost pricing. Well, thank you very much. I hope you enjoyed the presentation, and if there are any questions, feel free to ask me.